Good evening, and welcome back to Hurdle Rate. For this video, we're going to build a DCF model from scratch for Marriott. As you can see on the right over here on the chart, over the last year, the price has been fairly flat. It was this time last year, the price was about 290, 296 today. So really not much movement when you look at it that way, but obviously we've had the low of 210 and a high of just over 300. So let's dive into the financial statements and see what the intrinsic value for the company is. So come onto the SEC, type in Marriott, and you'll find, open up the first 10Q that you see. That should be for the first 9 months of this year. Then go onto the second page, and if you scroll down slightly, you'll find the 10K, and we want to open those for a second, but we want to open these up on the 10Q, come to page 15. Is it? Oh, where is it? It's at the top on this. To page 3, we want this one, and we want page 37 on the 10K. But if you go onto the second page of the content, you'll find the 10K there. So yeah, let's get straight into it. The first thing we do on your spreadsheet is remove your grid lines, go view, and also freeze the first column. Insert another column before the A, make your A smaller, your B larger, and in a cell A1, put MAR. This is the ticker for Marriott. Then select the cell, go data, go stocks, and it should allow you to choose this one, the one that's listed on the NASDAQ. Select that, and yeah, that looks good. We'll zoom in a bit so that we can see better. Then we want ticker, date, current, implied. We want to know if there is any up or side. Let's just do a bit of formatting. So we want to fill the cell with this this sort of beige color. We put a border on. Copy these over. So ticker, we just go equals A1 dot, open your square brackets, ticker. For current price, we go again A1, open your square brackets, price. We leave the implied and the up and down because they will be, we need the model to give us those values. The date today is the 11th of the 12th, 2025. Okay, yeah, let's start building out our assumption. Then X, sorry, put a capital X here. Go. Formatting. Fill this with a navy blue. Put the font white so that it is visible. Assumption. Okay, now we can start building. Now we want a revenue segment, which is base. Sorry, that's bare, base, full. And I'll explain as when we get to them how we're going to use these in the assumption. So revenue segment, we want base management fees. We're just going to use these as the as each segment. Franchise fees, incentive. reimbursement revenue. Okay. Then we're doing the free cash flow to the firm for this model. So we're looking to identify the cash flows that are available to both the equity and the debt holders. Therefore, we use the EBIT, which is the operating income. We use a WACC and a terminal growth value. And again, these will come later in the build. We don't have to worry about them too much yet, but I will explain what we do with them as and when we need to. Okay, and in your switch, just put 2. That is our base case. We want to leave it on that. So yeah. Now we've done that, we can go and start building do our revenue build. We want to forecast out until 2030. Write this down. Don't need here. Okay, perfect. Good. So yeah, go for the so the first revenue segment are the base management fees. And for those of you, so Marriott obviously is a hotel chain, but it doesn't necessarily own all of its properties. A lot of them are franchised out. So it uses the Marriott brand, but it's run independently. A bit like how when we looked at Starbucks and McDonald's, a similar model. So Marriott is fairly asset light and it receives its franchise fees. So that's what we're going to be doing now. It does own a handful of its, maybe more than a handful, but it does own some of its own properties, but the majority are franchised out. So on the number, have no decimal places. Use the thousand separator and the brackets to display negative numbers. That when for revenue that doesn't happen because for revenue. So the first, actually, let's build out a bit more. Bare, base, and full. Perfect. We won't look at percentage of revenue because it doesn't really matter. So we'll just focus on this bit like this now. So 1004, 1238, 1288. So yeah, from these management fees, we can work out the growth rate by just taking the year that we're looking at, divided by the previous year, and -1. Sorry, and to get 2025, we come onto our NQ. We can see that in 2024, by the first 9 months, they're at 955 million. They finished the year on 1238. So we're just going to take this 1238 divided by 955. That gives us 1.2963. Right, that can be our multiplier for this one. So we go equals 979 multiplied by 1.296508. It doesn't have to be that accurate, but we've done it like that. So yeah, as you can see, there was a big jump in 2023 as we were recovering from post-pandemic. And that seems to be plateauing now on the base management. All of these fees are either a percentage of profits or from revenue. So, and they're coming from the franchise. Because I think Marriott, it's got something like 9,300 properties globally. And they've got several different brands. You've got it's Regis, you have the JW Marriott Marquis. The reason I've chosen to do this is because I stayed in one last week with work. So yeah, that would be quite interesting to do. Yeah, but they also own things like Sheraton, Autograph. There's quite a lot that fall under the umbrella. Um, we would expect, let's say these base management fees, let's say they go to 5%. Format this so that it is two decimal places equals G10. Or well, certainly on mine, this cell. Make sure this is equal to this, because when we update these, we want it to update dynamically in the model as well. So the way we find out these three cells are, we just go equals, we take the previous year, subtract, open your brackets, the previous year minus the final year, close your brackets, divided by, open brackets, your final year minus your previous year. And we're just going to copy and paste this format into our other revenue segments. So we want certain things to be fixed and others to be dynamic. So the first one that we want to be fixed is this K29. We want the column fixed, but not the row. For this one, we want it to always be there. So we fix the column and the row. So you just put the $ before the letter and the number. And for this one, we want the column to be moving, to be dynamic, but the row to be fixed, which is why we put the $ in front of the row. Then we go like that. We just copy it along, and that will give us our growth rates forecasting for the next 5 years until 2030. For the bear case, we're going to say it will be 95% of the base. For the bull, we'll say it will be 105% of the base. So to work out these cells, we just go equals, you take your base, multiply it by your, in this case, the bear, but make sure you lock in the cell, because we're just going to copy it all the way across. Put it along like that. We do the same for the bull. There we go. And the whole point of these switches are that we can flick between all of these, so it generates different revenue forecasts. So here we just go equals, offset, then we pick the cell that we're in. In this case, it's G27, comma, the switch, which we have to lock in, comma, and put a 0 at the end, enter. Let's format it so it's a percentage, then pull those along. So to forecast the revenues now, we just go equals the previous year multiplied by 1 plus your growth rate, close brackets, pull that along, have it. And to show this at work, we're in the base case scenario now. So we're looking at these growth rates. Let's go to the bear. Remember these numbers now? You only need to look at this one because it's a round number, 1700. Watch it change. 1676, bear case scenario. Go to a bull, 1725. And we're going to do this for all of the revenue segments. And this will allow us to simulate different scenarios going forward. So yeah, that's the first one. Equal 11. So the base management fees is one that they have to pay irrespective. The franchise fees, I think, are the percentage of the revenue and the profit. 2505, 31, 313. Come back onto the 10Q. So to take 3113 divided by 2318, 1.34. Or 2482 multiplied by 1.34296.808. We will forecast this to, what should we say? So we'll say for this one, I think, yeah, we'll put it at 6%. The 11. We just have to make sure everything is linked to the right cell. So this to be 11, pull that along. Same for this one. Yeah, that looks good. This one, 12. Management. Back on A. Five. Okay, I mean, I don't think this is going to go at 14% growth, so we will put, let's put an average like that, and we'll say up here we'll put 5. Yeah, let's just edit the cell, make sure it's corresponding to the correct switch. Go. Okay, that's good. So actually, we do need to switch these around, though, because when it's a negative number, the lower can actually then, we'll put this to maybe to 3%. Keep it reasonable. Yeah, okay, that looks good. Next one, contract E13. Have a quick look at. Okay, so let's just go through and understand what each revenue segment is. So base in management and incentive management. For our managed properties, we have performance obligation by hotel management property brand name. As compensation for such services, we are generally entitled to receive base management, which are a percentage of the revenues of property, and incentive management, which are generally based on measure of the hotel profitability. That's clear. So these are variable because it's based on a percentage of figure. Franchise fee and royalty fee. For our franchise properties, we have a. Oh, so these ones, the base management and the incentive fees, are coming from Marriott owned property. For our franchise properties, we have a performance obligation to provide franchise operators use of certain of our brand names as compensation for such services. We are typically entitled to initial application fees and ongoing royalty fees. Ongoing royalty fees represent variable consideration as a transaction based on such a property. Okay, that makes sense. At our owned and leased hotels, we have a performance obligations to provide accommodations and other compensation for such goods and services. We are typically entitled to a fixed nightly fee for an agreed. Okay. So this cost reimbursement is just money that comes uh, back to Marriott, I guess, for providing certain services, but they don't charge any markup on it. So that is a zero margin um, part of the business. Okay, that's clear. The only thing they don't really say is what this contract investment amortization is, but let's not worry too much about it because it's a pretty small bit of revenue anyway. We don't really have to focus on it. Okay. Okay, that looks good. We'll probably say that we'll just put it at 5% as it's negative. Actually, let's just see what it's looking and I'll decide which way the sun goes. Yeah, I've got it right. Okay, yeah, that's good. Next one. We're going back to normal revenue now, these ones. So use the positive, don't use the one with the negative number when copying it down because 1367 is 4, 5 by 1, by 1133, 4, so 1, 2 multiplied by 1.36. Okay, so let's put this at about a 5% growth. Apologies for not being very talkative today. I'm full of flu, so my head is a bit fuzzy. Concentrate on more than one thing at once. So this last section is actually quite misleading for Marriott, because it's something that it's basically it's kind of like money owed from their, I guess, their franchisees, etc. So they just, for services that Marriott has provided, that they don't charge a markup on, so the margin is zero. Um, so really, I mean, these top five is really where the margin for the company comes from. So it looks like Marriott's doing huge revenues, when in reality, this should be irrelevant. Divided by 13,778, 14,347 multiplied 1.34385. Let's leave it at 3%. That's good. So this is the revenue bill. Let's get a total. We can move on to the next section, the income statement. A sum up each revenue line, and then we can pull it along. Okay. Okay. Yeah, that looks. We're happy with that. The next stage is the income, which is your revenue. We'll put equal to what we have up here. Pull it along. Make sure it's equal though, because we want things to update dynamically as and when we change our input, whether that's the growth rates or revenue segments, all of those things. So revenue. Next one is EBIT, which is your operating income. We'll find that on here, this line. You want to know what that is as a percentage of revenue. If you're on a Windows, get into the habit of using Excel without the mouse. It will make you so much more efficient. Um, on the Mac, it's a lot more difficult because the shortcuts aren't as good on the side, and they're not really as effective either. So hence why from quite regularly actually on these builds. But yeah, as a good practice is to not use the mouse. So you take your operating income of 2024 divided by this figure 3015. 1.5, so we go equals 3, 4. Fine. There we go. And this is just a placeholder, this EBIT forecast. So we do the proper one later. Taxes, we come over here and we provision for income. By 3, 6 by 9. Again, we just average long. Go. Hey, we're about 30% of the way there now. So maybe a bit further. The next item is cash flow. These are your depreciation and amortization. You know what that would be as a percentage of revenue. Also as a percentage of. We want capex. We want change in net working capital. Where we find these is we come to the cash flow statement, which normally goes income statement, balance sheet, and then your cash flow statement. Yeah, that's one. So we want depreciation amortization. So format, we go 400, 6, 492. For capex, that is this one, 32, 52, 50. And oh, amazing, they've done it for us. So these are the working capital changes. Normally it's a list of 4 or 5 items that we then have to sum up. But yeah, this is great. Sorry, they just formatted the number. So -2, 2025. Here we are. So if in 2024 it did 492 by the end of the year, it was 363 in the first 9 months of the year, the multiplier is 1.5. So we go 422 multiplied by 1.5, 3719. 408. Oh wow, so their capex in the last quarter of the year was huge. 33529. Change in net working capital. Just put it as okay. Of course, 400 divided by revenue, about 2% a year, the depreciation and amortization. Going forward, we will take an average of that, the last 3 years, pull it along the revenue. There we go. Don't worry about the errors yet, we're going to fix it. Normally that section takes a while because of the change in net working capital, but yeah, easy. Let's go on to the next section is the DCF, and it's just copy and paste pretty much what we've done earlier. Again, revenue, put it equal to what would it be? Control shift. There we go. Bit. Oh no, no, just do this up to 2025. So we'll keep this, let's say 16% EBIT margin. It looks like it can maintain it. Be a bit more generous. 70. Ooh. This will equal offset the cell that we're in, E9. Did I say was it C70? You just take your revenue, you multiply it by your percentage of revenue, which is your EBIT margin, Heaven. Next one is other taxes. And this one we have to link dynamically because as we simulate different EBITs, we want the taxes to update. So that was percentage of EBIT. So percentage of EBIT is your tax rate. Percentage of EBIT is taxes divided by EBIT. Go take an average. Take your EBIT multiplied by. There we have it. So as we simulate here, these are going to update too. Let's change this actually to the last few years because I think 2023 is such an anomaly in terms of the recovery. So yeah, that's better. I think that's a bit more realistic. So I'll just show you how that will work. Remember these figures: 4448 and the 884. Let's go into a bear case. See, it automatically updates as we toggle through the switches. Okay, the next step is we want to calculate the EBIT, which is your earnings before interest, but after tax. You do that by going EBIT. We only want it for the forecasted, for what we're forecasting beyond for the next 5 years. So we take the EBIT, we subtract the taxes, pull that across. Then down here, we want the DNA, the capex, and the change in net working capital. Put this equal to your DNA, but this one equal to your capex. This one to the change in net working capital, and just pull these along. Go. Now we can calculate the unlevered free cash flow. Do this by we take our EBIT, we add back in depreciation and amortization because it's a non-cash expense. We subtract the capex, we subtract the change in net working capital. That's it, the unlevered free cash flow. What we want to do now is, so these cash flows of what we're forecasting out for the next 5 years, we want to discount the value of these back to the present day. It's called the present value of unlevered free cash flow. To do this, we need to use a discount rate called the WACC, the weighted average cost of capital. And this is composed of many different components that we're going to calculate on the next page. So open up another sheet. Again, let's make it smaller, make your B column larger. Always remove your grid lines. We don't need to freeze anything though, but bar in your top, your cell A1. So I'll make sure it's connected because we want to pull some of the data from Excel. So we want to calculate the WACC, the weighted average cost of capital. And what this is, it's the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1, that's the tax rate. And to get all of these, we need several different line items. The first one we need is the market. And that we can just go A equals A1 open your parentheses, market cap. Make sure to divide it by 1 million though, as these are all done in millions. Yep, here. So when this is 422, it doesn't mean it's $420. It means it's $420 million. So there we have it. The market cap of Marriott is just under $80 billion. Then we want percentage of equity, which we can't calculate now because we don't have the correct. Then it's the cost of equity. And your cost of equity is your risk-free rate plus your beta multiplied by your equity risk premium. Again, we don't have those yet, so we'll come back to them in a second. The next one is we need debt, percentage of debt, cost of debt, tax rate. Then we want a total. The next bit, what's the next bit that we want? Wow. So the debt we get from the balance sheet. Back up here. We look down here. So current portion of long-term debt, 1557, plus the long-term debt, 14,442. 1557 plus 14,442. Even though that's irrelevant, sorry, I'm a bit of a pedant. Then we go. So now we have these two, the market cap and the debt, we can get our total. There, we can find the percentage of equity. We can find the percentage of debt. The cost of, let's do cost of debt first. The way we find this is we look at our interest expense. So 601. This is for the first 9 months. So let's divide this by 3 and multiply it by 4 to get the full year. Equals 601. Also just so divide by 3, multiplied by 4. So we would then just go 801.3333 divided by that. It's about 5% interest rate. Their tax rate is income taxes. So 23.3%. So now all we have left to build is the cost of equity. So the cost of equity equals your risk-free rate plus your beta multiplied by your equity risk premium. So we know the risk-free rate. We just use the US 10-year treasury. Let me just refresh this so that we can see what the 4.128. 4.128%. The beta, we need to look at our here we are. So it's only going to be one industry for Marriott hotels, 0.74. So we don't really need to go into the full build out that we do in other builds. So we'll just go this at save time 0.74. when next time I do a company that has multiple industries within it, we can properly build out the beta. But for now, let's not worry too much. The equity risk premium, though, this one we have to build properly. So we need to focus on the region, the revenues in that region, the ER, the ERP, the weight, and the weighted ERP. So let's see how Marriott breaks down its revenues by. It does do them, but we need to see how it does. This is what this is what we need to. Yeah, that's about occupancy. These are revenues. Okay, so for the first 9 months of the year, let's break it down how they do it. So US, Canada, then they have EMEA, that's Europe, Middle East, and Africa, Greater China, APEC. The revenues are as follows. Fourteen four zero one 1782 30 766. Well, so I mean, revenues are predominantly from North America. So we want to take, so this is the weighted equity risk premium for North America, which is 4.58%. We'll use that. Then for EMEA, we have this one down here, 6.22%. Greater China, do we have one? Greater China, 5.25%. And APEC, so Asia Pacific excluding China. So if we take, let me delete the China line out and see what it comes up with. I'll take out Hong 2. Yeah, we get 6.73%. Okay, that's perfect. That's what we want. 6.73%. Okay, so now we want to know what the weight of each region is. We simply just multiply the ERP by the weight. But we want percentage, pull it down, and we just sum 4.86. Very small ERP. Okay, so yeah, now we can calculate our cost of equity. We take our risk-free rate, we add the beta multiplied by our risk premium, which gives us 7 point. Okay, so now we can calculate the WACC. The WACC is this formula up here. So we start with the percentage of equity multiplied by the cost of equity. Actually put this first section in brackets. Plus your percentage of debt multiplied by the cost of debt multiplied by 1 minus your tax rate. Yes, 7.07% is the WACC. So come back onto our main sheet. And put the WACC equal, the base WACC equal to what we've just calculated. For the bear, we're going to add 0.5%. For the bull case, we're going to subtract 0.5. Because the lower your discount rate, the better it is. The higher it is, the riskier. The terminal growth value will leave at 2.5%. For the bear case, we'll make that 2. Okay, the WACC, we just go equals choose. Instead of offset, we use choose. Take all of these in order. Put it down for the same here for the terminal growth value. Okay, we're almost done. Above on the DCF, above the forecasted figures, just put 1 to 5, well, numbers 1 to 5, because we're going to use that, you'll see, as we calculate the present value. To do that, we take the unlevered free cash flow, we divide it by 1 plus the WACC. Make sure to lock your WACC in, close your brackets, to the power of, to the power 1, because, yeah, we'll just pull those across. So these are the present value of the free cash flows that we forecasted. Now, the next step is to calculate the terminal value. And that is done by you take your final year of unlevered free cash flow and you multiply it by 1 plus the terminal growth value. Then divide it by your WACC minus your terminal growth value. Then we want the present value of this figure. So if the terminal value is 100 billion, we want to know what that is in today's value, not in 5 years. So again, we divide it by 1 plus the WACC to the power 5. Unbold. This leads us to calculating the enterprise value. So all that is you just go equal sum, your present value of your terminal value, and all of these unlevered free cash flows that we've forecasted the present value, which gives us about 87.5 billion. We want to add the cash back in and subtract the debt. So we know the debt because we've done it before. We did it on the for the WACC. We didn't add up the cash, so we take this figure 678. The debt we know because it's here. go. And after the enterprise value, because we're taking out the debt, so we're looking at just the purely what's left over for the equity. When we take the enterprise value, we add the cash back in, we subtract the debt. That gives us over 72 billion. We find the diluted shares outstanding, to which will give us the implied share price. Your diluted shares outstanding are, where is it? Here we go. Yes. So here, so we just have to do this multiplied by the net income. We'll have the right amount of shares. So we go equals 7.4 multiplied by 1. So I found it. So we just go onto a few pages down onto page 8. We can see, so their basic share count is 274.3. But when you add in the stock-based compensation, that hasn't been taken into effect, but it could be. The diluted share count is 275. So that's the one we're looking at. The implied share price is just your equity value divided by your diluted shares outstanding. And there we have it, 263. So K26. 126, sorry. Work out the up or downside. So yeah, so maybe an 11% downside. Let's look at the bear case. So 193. If we were to put this onto a bullish scenario, about 372. Okay, so on the bullish, there's a significant amount of upside there. Come back to base. Let's see what it would look like if we if we use the terminal growth value as 3%, we actually get to a fairly fair value. I think I've been too low on the terminal growth value in previous builds, which is why it maybe becomes significantly less. Basically, this figure should never exceed GDP growth, but I think should be somewhere between your the inflation rate and the economic growth. So yeah, let's put that on. Let's do that on 3%, and we'll start doing that from now on. Yeah, but otherwise, yeah, it's fairly fair value. Okay, cool. Yeah, hopefully I'll feel better on the next one, and it'll be a bit more engaging. And yeah, thanks again, guys, and I will see you on the next video. Thanks, bye.